I'm so sorry. You're back. I gotta wait for y'all to come back. I'm so sorry. I don't know what happened. I think the internet got excited. We gotta wait. I'm so sorry. I'm so sorry. I don't know what happened. We're back though. We're back. We're back. We're back. I'm so sorry. You gotta come back over here. I'm so sorry. I don't know what happened. I don't know what happened, sis. I'm so sorry. All right, we're gonna get back into it. We're back, Dee. Alexa, pause. Okay, so we're back. I don't know what happened. You know, these things happen when you're internet, right? Getting into it, we were talking about how student loans will impact your ability to purchase a home. We're talking a little bit about how it would impact your DTI. We had a lot of great questions. And Tasha, if you can tag Fallon, because Fallon had a really good question. If you can tag her in the comment section, just tag Fallon. Smith is her name. Thank you guys for coming back. We're going to get those questions answered for you again. We're sorry that we lost you, but we're going to make sure that you get the information that you need. All right, so we're just going to jump back in there and then you guys catch up. So now there's two, okay? What we were saying is we were talking about how student loans impact your ability to purchase a home. And then, yes, you're back. Okay, good, Cindy. All right, and then we were getting into Ivy's question. You can also tag Ivy as well, Natasha. Ivy was asking a question about what happens when you are an entrepreneur and you are writing off so much of your income so that you can be able to, you know, reduce your tax liability and how that impacts your ability to purchase a house. So we'll let you pick up there.
Okay, great. So we were talking about basically the income tax returns, right? So with the income tax returns, I urge a lot of folks that are starting their small business or have already owned a business that they get a CPA, invest in yourself, get a CPA or get an accountant to really look at your taxes, but also look at how
So let's talk about that. Hold on, yes. Mark. So let's talk about that really quickly, right? So what if you fear, right? So the language of a CPA, that just feels so big, you know, like you feel like I just have this amount of money and talking to a CPA, it just feels so intimidating. So what would you say to those that feel intimidated? Like I'm only making maybe $45,000 or $50,000 and sitting with the CPA is going to be too expensive. I'm not that sophisticated. I don't know what they're talking about. So how would you say that they would mitigate some of that mindset noise?
Great. So I would say that one, maybe even speaking to your tax preparer. Okay, your tax preparer should be able to break down for you exactly what's the profit coming into the business and what's the expenses going out. Okay, so at the bare minimum, talk to your tax preparer, but also you as that business owner, whether you've been in business for 2 years or more, hopefully you're listing what the income is coming in, you've recorded that, or you're listing your expenses and you've recorded that. And now you're going to understand how much income is truly coming into the business and what you're paying yourself. But definitely a tax preparer can help with that. So
yeah. Let me jump back in. I'm sorry, Mark. So yeah. That was not me. That wasn't me saying in a way that you should not use a CPA.
Correct.
You know, that's not me saying that. What I'm saying is that get over the fear, because oftentimes the amount of money that you think that you're going to save by working with someone that has like a lesser professional title, what I have seen in my own experience with working with clients, with working with my own money, your avoidance to hire a professional is actually costing you. So while you don't feel that you're sophisticated enough to meet with the tax preparer or to meet with the CPA, or you're kind of hiding or you're kind of avoiding, that's really costing you. So whatever mind noise that you're telling yourself that this is going to be too expensive, you'll end up paying it in the long run. You'll end up paying it in paying more taxes. You'll end up paying it in just getting bad advice. So for those of you that are sitting in and you're an entrepreneur, solopreneur, whatever it is, that's the one takeaway that I want you to take today. I want you to actually call a CPA. I want you to call an accountant and I want you to ask them, how much will it cost for me to work with you? Okay, so I just want to insert that just a little bit, but finish what it is that you were saying.
Yes. So, as it relates to the income tax returns, there's a lot of individuals that own their own business and believe that by filing a lot of deductions, they're going to get back more, right? At the end of the year. Well, that could be great, and that sometimes is. But if you're looking to buy a home, what ends up happening is if you're just doing that to hopefully get more of a refund, it might hurt your bottom line as far as that gross monthly income or annual income that we're going to look at to be able to qualify you. So I would always say that be careful of the actual deductions that you may have, because not only are we going to be looking at that as a business owner for that current year, but we're also going to be looking at the average for the last 2 to 3 years to see that the income has hopefully been progressing over the years and increasing. Now, we do understand that some individuals who own a business are seasonal. Their business is seasonal, that they're not necessarily always going to make the same type of income every month. And we understand that and we realize that. So that's where the letters of explanation are definitely going to help explain that story. But we want to make sure that as a owner that income is increasing over the years, because we are going to most likely ask, but also look at the average. So be careful with the deductions. Get yourself a CPA or really analyze your business in a way that looks at that income and expenses, and you can see exactly where your projections are for a few months coming forward or the next year coming forward.
Okay, and I want to expand on that a little bit more, because that's something that I've seen like very commonly, is that people want to be able to get, reduce their tax liability, or they want to make sure that they get a good tax refund. And then what ends up happening is they reduce their income all the way down to $30,000, $40,000, right? And when you think about the average cost in South Florida is $350,000. Think about it rationale. So if you're looking at yourself, if someone's asking you to borrow $350,000 and you know that they only make $40,000, how likely are you wanting to give that person any money? So think about it in that regard. Think about it like, would I want to give you any money? Would I want to loan you anything? Because you're saying you don't have any money. So how are we going to get you into this $350,000 house? So I'm glad that you asked that question. Also want to tag in Fallon. If we can tag in Fallon Smith, she had a really good question. So Fallon was asking, the question was back. So, hello, what's the best credit site to see your score? And what's the difference between a credit score and one more, LOL? What to do if you're working on raising your score? Okay, great question, Fallon. Loaded, but great. All right, so I'll let you go, Mark. You can answer it.
So with that, there are a lot of individuals that believe that Credit Karma, and I'm not knocking Credit Karma, and I'm not knocking some of the other sites that are out there. Some of those sites are good for you to get a gauge of what that credit score might be, okay? But please know that as a lender, we're going to be looking at pulling a hard credit report that looks at different algorithms as it relates to you being able to purchase a home. So sometimes with a Credit Karma or an annualcreditreport.com or even Experian, those scores are 10 to 15 points, if not more, off from when we as a lender actually pull your credit. So right now, I will tell you that we are doing working with individuals that have a credit score of as low as 580 or higher. But ideally, you really in this mortgage industry right now and buying a home want to be at 620 or higher. And definitely, if you're looking to access any of the down payment and closing cost assistance, that's where you really want your score to be. So I always say, if you're looking at Credit Karma, great, not bad. But if you tell me that your Credit Karma score is a 580, that means you might not quite be ready, because we don't want to take the chance of actually pulling your credit score. And remember, we as a lender are under those different algorithms, and it comes in at a 550. So it's a gauge for us to be able to tell you, yeah, I think we can move forward. So if your credit score is at a 650, chances are it's above the 580 when we pull it, and that's your middle score, your FICO score that we're going to be looking at, your Fair Isaac credit score that we're going to be looking at.
All right, thank you for answering that question. That was a really, really good question. And actually, in answering that question, you actually created even more questions, right? And doing that, you said you used a bit of loaded language, and so I want to take that apart. So the first, one of the questions that that was raised, people were asking, should I go on Credit Karma or should I look here? Credit Karma is really good for identity protection. That's what I would say. It's really good for identity protection because if something hits your credit report, it's going to let you know that at least made it to your credit report, right? But if I was looking to purchase a home, it is not where I would be going to, you know, if I'm 3 months out, 6 months out, you know, if I'm watching my my credit score to the date of my closing, that's not the place that I would be looking at, because what you're looking at on Credit Karma is just your Vantage score. It's just a Vantage score. That's a new market that came out during 2008. So it is not the most reputable place to get your actual score. It doesn't show your account numbers. It doesn't reflect your account balances in the best way for someone to decide whether or not if they want to get a mortgage for you. Now, I'm going to add to that just a little bit. The other part of it is that the way, so when you're pulling your credit score, when someone is about to give you money, they have their own lending guidelines, right? So that's why your credit score is not the same from one place to the next, you know, because these individual entities, the banks that you're working with, the car dealerships that you're working with, they all have their own whether or not if they want to loan you any money. So that's one of the things for you guys tuning in. I want you to kind of relax and know that if I pull my credit score on this particular website, that if I go in and I sit in with a mortgage broker, there is a high probability that my score is going to have some level of differentiation. It's going to be different by some regard. It's not going to be exactly the same. So just know that, because all of these lending institutions, they have their own matrix to decide whether or not if they want to give you a loan or not. So don't get completely sticker shock. Don't get altogether sticker shock when you see that. If I was looking at my credit score from one place to the next, if I saw maybe a differential in points between 5 and 10, it's not going to rag me. I'm not going to have an anxiety attack. But if I'm seeing 25, 50, 100 points, that means that there must be some errors on my credit report that I need to look into. So that kind of takes care of whether or not if I should look at my credit report on Credit Karma, or if I should look at it, you know, when I'm dealing with a lender. The best thing to do is when you have set a relationship with a lender, that's where you go to be seeing what your credit score is, because they're giving you the money. They're making the decisions about how you operate with money and whether or not they want to give it to you. Now, also, in you responding to that, you mentioned two other things that I'd like to elaborate on. One of them is you were saying that you could give a loan to someone to purchase a home if their credit score is at a 580. What is the likelihood of a mortgage loan being issued to someone with a 580 credit score in the COVID economy? How likely is that?
So great. And I will tell you that I've recently done some loans that are about 585, right? So the minimum is 580. Now, what helps that individual for having that type of credit score is how much money are they putting down? Are they buying a condo versus a single family home? Is there another individual on the loan with them as well? So a lot of those factors will be taken into consideration. And sometimes we just have to put it through the system and be able to analyze it and have that consultation with the client to be able to say, hey, listen, yes, this seems a little bit risky. However, you do have that 580 or you do have that 582 credit score. And in this market, even COVID-19, if there's some other factors that can offset and compensate that credit score, that will also help look at the overall profile of that client. So just keeping in mind, it's not always just based on their credit score, but it could be based on the credit score and maybe they have 6 months reserves of an estimated monthly mortgage payment. So let's say, for example, my monthly estimated payment on my mortgage is $1,000, but I've saved $7,000. That means I have some money set aside as well. And maybe I'm buying a single family home and not necessarily a condo or a duplex, which in this market may be considered a little bit riskier for us as a lender. But absolutely, you're going to want to have all those other factors in place.
All right. Now, another question that you answered, and then Cindy, we're going to get to your question next. Something else that you mentioned that you would like for someone to be at a 620 in order for them to begin to qualify. So 580 could get you in the door if you have some compensating factors, how much money you have saved up, how long have you been with your employer, do you have negative things on your account that you haven't paid? All of those things should be, considered. But you specifically about a 620 credit score. So once someone has it, so at 580, you cannot qualify for any down payment assistance.
Correct. Okay. And that might very well be, I'm not sure about other lenders, but that's a Paramount Residential Mortgage Group lending guideline, okay? PRMG lending guideline. So we want those credit scores to be at a 620 or higher if an individual is looking at a DPA, a down payment assistance program. And the reason being is, basically what we're saying there in that profile is you don't necessarily have all the money saved, and that's why you are adding a DPA program to the overall profile. And based on the overall profile, you might be considered a little bit riskier. Hence why the 580 credit score in our internal guideline might not be sufficient, and that's why we're going to want it to be at the 620 or higher for a loan that has down payment assistance associated with it.
Perfect. All righty. So we got two questions, one from Cindy and one from Dee. All right. So the one from Cindy is saying, once your credit report is pulled, how long are your scores locked in terms of being the same for a certain time frame? Meaning, is it like 14 days or 30 days in terms of when we pull our score? How long can I lock in my rates?
So the moment that you actually have a contract in place and you want to go ahead and lock in your interest rate, after we pulled the credit score, and trust me, what I tell my clients is I go over the interest rates and the cost or no cost associated with each of those interest rates. I'm very transparent when we do that because I want the clients to understand, based on this particular credit score, we're ready to hopefully lock in that interest rate. That credit score might be coming with a cost associated. I mean, not the credit score, excuse me. The interest rate may be coming with a cost associated with it. And I want you to be aware of what that cost is, because that may be very well be a part of your overall closing costs. But the moment that we lock in that rate could be locked in for 15 days, 30 days, or 45 days, or even 60 days, giving us enough time to close your loan within that time frame. And once we've closed that loan, that's going to be your fixed interest rate for the life of the loan, whether it be 15 years, 20 years, or 30 years. Hopefully,
so would you in the COVID economy, would you recommend locking in rates? Are you seeing that rates are going down over time? Because I know they're the lowest that they've been in years, but in this economy, month to month, as you give out mortgage loans, are rates going down or are they kind of staying the same? So, what is the sensibility in doing a rate lock at this time on a home loan?
So great. And I would say that, rates are going down, and they have advertised rates being at a very low, but it depends on the overall product, FHA, Fair Housing Administration, or a conventional loan product that you may have. Typically, the rates on a conventional loan are a lot higher than an FHA loan. But once again, we are more concerned, I'd like borrowers to be concerned with the cost associated with the rate. So on any given day, a 3.5%, as an example, interest rate could be costing either $2,000 or $4,000 or even nothing. It really will depend on that client's overall profile. But in this market, I do suggest once you have that contract, locking in the rate for at least 30 days at the very least, okay? And in some cases, you might need a little bit more time, but we as lenders can give a little bit more time if you need an extra week or so at hopefully no cost to you. But I always urge clients to making sure that we're locking in the rates immediately, especially in this market, because although you might be getting a 3.5 today, I don't want to take the chance of that 3.5 interest rate costing you an extra $2,000 if we were to wait another 15 days to lock.
But what's the likelihood in this market of that happening? Like, what's the, like, with the economy being what it is and rates going down, what is the likelihood of like a rate going up within the next 15 days? And how much is it costing me to put, like, on average, how much is it costing me to lock in my rate?
Well, so to answer the first part of the question, I would say you're not going to see much fluctuation, okay, as far as the cost or even the rates right now. You're not. But I will say that it really depends on the overall profile of that client. And like I mentioned previously, not only the credit score, but also how much money they're putting down and how much, or the type of property that they're buying. So it will really fluctuate. But I would say just for the rates alone, you really need, just for the cost associated with the rate, I'm seeing anywhere between as low as $500 to as high as $2,000 or $2,200.
Over the life of the loan, or just a single payment?
That's a single payment as a part of their closing costs. Absolutely correct.
Okay, so a single payment. All righty. So we'd have to weigh those out, but I hear what it is that you're saying. So the next question would be from D. Do you look at the monthly payments that are being paid, and do you take in consideration the rent payment as well? So what she's asking is, let's say all she has right now is her rent. You know, that's the only thing that she's paying. How does that factor into her ability to get a mortgage?
Right. So we want to make sure that there's no huge payment shock. Okay. So if you've been paying $1,000 consistently for the last 2 years or 3 years, we want to make sure that there isn't a huge payment shock to you. Even though you might be able to afford it, it's something that any good loan officer is going to go over with you. So if you've been making $1,000 in your rental payment, just keeping in mind, can you really afford an $1,800 payment? Okay. But that's one of the things I love to talk with my clients about, keeping you in line or close to where you feel comfortable in making that monthly payment going forward as it relates to your mortgage. But now, as it relates to your debt and the debt to income ratio, we are not going to take into consideration your monthly rental payment in that. What we are going to look at is the credit debt that you have on your credit report and the minimum payments that you're making on that credit report. So to the example, we're not going to be looking at your rent. We're not going to be looking at how much you're paying on your cable bill or your electrical bill, okay? We're not going to be looking at that for the purposes of the debt to income ratio. However, it is a good teaching point and talking point. You want to be able to look at those other items, FP&L, or excuse me, your electric bill or your cable bill, as it relates to your actual budget. Okay, so I'll leave it at that. But for us as a lender, we're really going to be looking at the minimum payments on your credit card or credit report.
Okay, so how, as you as a lender would look at, let's say, I do not actually live in a rental complex. Where I live is with my cousin, my brother, my sister, my mother. What will you accept from me that I have been making these payments on a monthly basis?
So as it relates to making, if you're not making any payment, let's say, and this happens all the time for a lot of first-time home buyers, they're trying to gather all their monies together and get their credit report, right? And I get that. So if you've been living with a family member or a friend and you haven't been paying any rent, that's also okay, right? That's not too much of a concern for us as a lender. We are going to ask for a letter of explanation. You know, how is it that you are living with this individual or family member and not paying any rent? That's fine. It's not going to hurt the decision for us, but we want to make sure that that's where it ties back to what we discussed earlier in reference to the credit report and making sure that you're still an individual that hopefully is paying their debts on time, even though you might not be making a rental payment to a landlord or a rental payment to a family member or relative. So we are going to be looking at that, but not for the purposes of saying nay or yay to your loan.
All right, so we have two more questions. We're going to wrap up with the show. We have two more questions. This is a very interesting question, and I'm going to bottle it up for you guys. And for those of you, I'm going to drop in the comment section is that for those of you that are working hard and you're dealing with some levels of stress while you are saving and making and creating and sharing all of this money, I am doing a free yoga class this Wednesday. Okay, so I'm going to drop that in the comment section if you guys have not registered. I know we talk a lot about money, but I want to make sure that when you get the money, you always have clarity about what to do with it. And I want to make sure that you're not so stressed out that you're making silly decisions. So I'm going to drop that in the comment section to make sure that you register for the free yoga class. It is on Wednesday. All right. Now, to your question, Cindy, she's saying that my rent is actually my current rent is actually more than my projected rental payment, but they still see me as high risk. What do I do?
Wow. So I would say maybe switch lenders, just joking, but no, seriously, I would really say that looking at your higher payment, being able to show us that you have be able to making that payment for the last year or 2 years is going to be to your benefit. So what we may very well ask for is a letter from your landlord if you've been making those payments on time. And as long as the income is there to be able to support whatever we've calculated for your estimated monthly mortgage payment and having the backup as far as what you've been paying on your rental, even though it might be higher, right, than what they are actually seeing or looking at, that's okay. It's being able to really justify for us as a lender that you're able to afford this monthly mortgage payment going forward with all the estimated debt that you have at that point in time in the qualification. Not necessarily what the future would look like, but at that point in time when we're doing the qualification, are you able to afford that payment? So hopefully I've answered the question, but I will tell you this, even if your payment is a lot higher than whatever the document shows, I would always urge you to get a letter from your landlord or your family member or someone that basically can help support what the actual payment is. And then the history of making those payments on time will definitely be to your benefit as well.
I'm back. It's damn kind of internet thing. I'm so sorry. Internet. Okay, so I needed your contact information for real. So please, Mark, be sure to drop that in the comment section. And one last myth that I'd like to dispel in our little bit of more time together is that I'm always hearing lenders all the time saying, you know what, it's going to be way cheaper for you to buy this house than it is for you to rent. I just need you to kind of like break that down, because oftentimes when I compare it, sometimes those numbers are higher, right? They're higher, right? And I see it all the time. It's way cheaper to purchase a house. So what would you say to that? I have a thought, an idea, but I want to hear your perspective and then I'll share mine.
Great. So my perspective with that is, it really is going to be a personal choice, right? And this is my perspective on it, that making sure that you're able to hopefully make whatever that payment looks like. And in some cases, you'll have clients, we have seen clients that their estimated rent is higher than their estimated monthly mortgage payment. But keeping in mind with the rental payment, that rental payment would probably be whatever that landlord has decided to charge, or whatever the market says that that landlord should possibly charge. But what I will tell you is, in some cases, you're not paying for certain things related to the monthly mortgage payment. in a rental situation. So the monthly mortgage payment is going to consider the principal and the interest that you're paying on that particular loan. Okay, it's going to look at whatever the tax bill is for that property, whatever the insurance that you use, to hazard insurance, to cover that property and protect it. And maybe you might have flood. So those numbers start adding up and creating your PITIA, okay, your principal, interest, taxes, insurance, and sometimes an association due, okay, for a condo. So I will say that some cases, you may very well be able to get a lower monthly mortgage payment than whatever the going rental payment is. And even in some cases, vice versa. But remember that in the rental situation, you may not be paying for the extra taxes or the insurance to cover that and protect that property, whereas opposed to you will be paying that in your estimated monthly mortgage payment. So it really will depend on a personal decision on where you're at and what you feel comfortable in paying. There's a lot more responsibility, of course, with the monthly mortgage payment on a mortgage and buying a property than there may be with a rental payment. But those are some of the different factors that go into actually making a payment, and hopefully we'll make the decision on whether or not a rental situation is better than a buying situation for you or purchasing a home situation for you, or vice versa. So it really is going to be a personal decision, but I would always suggest having your lender run the numbers on both. This is what your rental payment is, this is what you're telling me, and this is what your actual payment would be as it relates to your mortgage payment on that particular home that you are buying. And see if it makes sense. But just realize that there are going to be different factors that we're going to consider compared to the rental payment versus the actual estimated monthly mortgage payment.
Alrighty, so thank you so much for breaking that down. I actually agree with you. We know Shani doesn't always agree, but I actually agree with you. I actually agree with your perspective. And some other things, though, is that what we're looking at, when we're looking at the dynamics, for me, in my own perspective, when we're looking at the dynamics between choosing whether or not if we're going to rent or if we're going to purchase a property, right? That rental, right, while the cost may be the same to rent, sometimes I look at it with my clients, they're going to get their rent and then their mortgage, they look the same, right? And then sometimes I'm looking at my clients and the cost for them to purchase a home is definitely maybe about $300 to $400 more pricey than it is for them to rent, right? So then it starts to come down to another conversation where the conversation is no longer about cost. Now we've moved into a value assessment, right? The value that comes with paying that additional $300 to $400, right? So does that make sense to you in terms of now this is something that I own? Now this is something that I can leave to my children. Now this is something that I can possibly get a loan against. This is something that I can leverage in the market, right? Which is something that you cannot do with the rental. So sometimes in terms of the mathematics, you will find in my experience, in my research, that for the most part, you're always going to pay a little bit more than the mortgage than you are paying for a rental. But the conversation when you're making that decision is not so much for dollar. It's about advantages, rewards, and what are you getting on the other end. So we're going to go ahead and thank you guys for tuning in today. We do hope that we have shared at least one thing that has added some value to your purse. Marc, I thank you for sharing value with us today, opening our minds about the cost of living, the cost of purchasing a home, whether or not if you should pay that debt, whether or not if you should deal with that medical debt or just keep ignoring them people when they call you, sis. That's all we were talking about today. If you're a little bit stressed out and you can use some creativity and you can use some clarity, be sure to join in on my free yoga class, because I want to make sure that not only you have a lot of money, but you have a lot of mindfulness to go with it. Fallon, I'm glad that I was able to answer your call. We'll be back here next week on Mondays. I'm going to also drop the link if you are not getting the automations for when we go live on Monday. I want to make sure that you do that. Do you have any closing words, Marc, to share with us? I know there are some people that wanted to know where to find you. So where can they find you if they would like to talk to you about their home ownership goals?
Great. Thank you, Shani. Shani, once again, just thank you for having me on. I love the work that you're doing, and I really am here to help a lot of first-time home buyers and buyers in general. There's tons of money out there for down payment assistance and housing assistance that I'm able to access for a lot of first-time home buyers. So I look forward to helping you, working with you. And even if you don't work with me as a lender, I know that I can hopefully point you in the right direction. So thank you. And if anything else comes up, feel free to let me know. But I look forward to working with all of you. And thank you, Shani, so much once again.
All right, sis. Well, if you're not feeling richer after all of that rich content, I'm going to do the thing that we always do. I'm going to ask you to open up your spiritual purse, your actual purse, whichever one of your purses that you feel the most connected to, right? And I'm going to give you some money, honey. All right. So remember, what you imagine in your mind, it won't be long before it show up in your bank account. All right. Whoa, it almost worked. I hope you're feeling richer. I'll see you guys next week, and I hope that you join me for yoga on Wednesday. Until next time, do something that's going to add value to your purse.